Welcome to Behind the Research, where we go behind the latest research from the Journal of Financial Planning. I'm Ben Lewis, and today I'm joined by Dr. Mathieu Vaissie, a partner and head of investment research at Ginjer AM in Paris, France, and a lecturer at the University of Paris Dauphine. Mathieu authored the latest research in the May issue of the Journal of Financial Planning titled Islamic Wealth Management and the Decumulation Problem. What is the Shariah Compliant Golden Rule? For the Muslim community, which accounts for over 25% of the global population and has assets under management that nearly surpass the ESG fund market, the conventional 4% rule just doesn't hold up. And until recently, there weren't enough Shariah compliant investment options to even build a workaround. Matthew's paper tackles that gap head on, asking two big questions. What's the right withdrawal rule for Islamic wealth management? And how do you build a diversified Shariah compliant portfolio to support it? Mathieu makes the case that a 2.5% safe withdrawal rate offers the safety margin Muslim investors need to sustain 30 plus years of retirement without compromising their values. Over the next few minutes, we'll explore what inspired this research and how you can apply it to your work with your clients. Thanks for joining me, Mathieu, and welcome to Behind the Research.
Well, hi, Ben. Thanks for having me.
Well, it's great to have you here. I appreciate you joining us despite the time zone change. I know it's a little bit later at your
to be with you.
Well, it's great to have you here. So let's start with the why behind the research. What were you seeing in the profession or the broader landscape that made you believe this research was needed?
Mm-hmm. Well, Ben, I've been working in the finance industry for 25 years now. I worked with private investors, essentially high net worth individuals, family offices, private banks, and institutional investors as well, like pension funds and sovereign wealth funds in the US, in Europe, in Middle East, and in Asia. And what I've seen over the first, say, 15 years, were investors who were essentially performance centric. And so the core of my research back then was essentially on building a robust portfolio, optimizing its risk-adjusted performance. And I did my PhD in the early 2000s on alternative diversification, very concretely. And interestingly, over the last 10 years, what I've seen is progressively investors becoming a bit more holistic in the way they approach their portfolios. And that's the reason why I started probably like 10 years ago, looking at extra financial dimensions. Like in the first place, it was about cognitive and behavioral biases.
Mm-hmm.
What's the impact and the way investors manage the portfolies, what's the impact on the way they will build them in the first place. And then progressively, it started to widen the scope. And especially in Europe, I mean, we had investors looking for the integration of extra financial data, such as ESG, for environment, social, and governance issues. So we worked on that. I mean, to try and understand how we could actually build a portfolio which is optimal from a performance perspective, but which is also aligned with our investors' preferences in terms of ESG. And lately, I would say I went a bit further, one step further, and tried to understand what could be the impact of the integration of moral values in the diversification of a portfolio. And that's how I got to get interested into Islamic wealth management and how we could build Shariah compliant portfolios.
Interesting. So as you were working on the research, did you come across any surprises? Anything like really jump out at you?
Well, the first one, I'm not sure is, I'm a bit of a geek, so I'm not sure everybody will be interested, but I'm a scientist geek. I would say that the first surprise, but I was not fully aware of the fact that, I mean, back in the 17th and 18th century, two fields like economics or and moral were so much intertwined. That was quite a surprise to me, and it was a reminder that I mean, it's always interesting. I mean, to revisit from time to time what the ancients wrote, you know, because even if we obviously we accumulated a lot of knowledge in the meantime, but sometimes, we may have lost some wisdom along the way.
Sure.
So that was my first surprise, because obviously I've studied with the Chicago school, and I've learned about the Homo economicus, so I was pretty far away from that. So it was quite interesting to see a different perspective. The second surprise, which is more pragmatic, I would say, is that I was curious to see how in Islamic finance they could make do without the use of fixed income instruments. They have what they call the prohibition, which is the riba, which is the prohibition of interest rates, basically, in all its dimensions. So I was curious to see how they could build portfolios, diversified portfolios, if it was possible. And that was the opportunity for me to discover a new form of investment, which I didn't know, which is called the sukuks, which is also referred to as the Islamic bonds, which, at the end of the day, is pretty much like an asset-backed security, but with underlying the vehicle different instruments, different agreements, which are Shariah compliant. But this was actually the way I discovered that today there is actually much more diversity in the investment solutions that are available in the market for investors who wish to adhere to the Islamic ethics. And I was quite surprised actually to see that it's possible today. And I think it was not possible just a short while ago. But today it's possible to build fairly diversified portfolios. It's not perfect, but it's quite good actually.
That's
Herbert
great.
Simon would say that it's satisfying. It might not be purely optimal, but it's pretty close to, and still it responds to very important points which make it possible for people who were not able to participate to markets until recently. And I would say that now these people, at least some of them, they actually have the possibility to participate to financial markets, which is quite interesting. Yeah. And the last surprise, which is purely empirical, and which is a collateral effect of the second one, is the fact that I was interested to see that the price to pay, if I may say so, to adhere to be compliant with Sharia rules is actually not so much about an underperformance, which I would have expected since we were adding constraints. But actually, the performance difference is not significant. What's the price to pay, if I may say so, is actually more about significant biases in terms of sector, typically technology, and factor exposures. And for the factor, typically we will have the size. If we look at pharma French factors, we would have typically the size factor and the growth factor, which would be overrepresented. Not a problem, but always interesting. To have a sense of what kind of animal we are dealing with, if I can say.
It's fascinating stuff. And so I'm interested always in exploring kind of the practical application of research. When our members are reviewing the research in the May issue of the journal, what do you hope that they're going to be able to take out and apply to their work with their clients?
Well, I think that something that is really key, it's that guiding clients today in the financing of their life projects is not about performance, just about performance anymore. Obviously, clients, they usually come for performance, but more often than not, they don't stay for performance. They stay for alignment with, as we mentioned, their risk preferences, but also ESG preferences, moral values, whatever they want actually to take into account in the way they build their portfolios. At the end of the day, investors, they are consumers like others. Okay, so this is something that we have to take into account. And what is important is that when you take all this into account from the very beginning, throughout the whole investment process and through the whole portfolio construction process, not just at the very end and just for purely cosmetic reasons. When you really integrate, those extra financial dimensions into the process, what is interesting, as I mentioned, is that you can actually optimize the performance of your clients, because that's obviously always the concern. I mean, if I do respond to this constraint, will I be able to deliver some decent performance? The answer is it's possible, provided that you take into account, I mean, all the dimensions of the problem from scratch. And this is something I think that is I mean, absolutely key. And that's what I recently read a book which was called Wealth 3.0. That's pretty much, I mean, the way I see it. If we do the parallel with the web 1.0, 2.0, and 3.0, that's, I mean, I think that's the next frontier, where the way we will, I mean, a company, the way we will guide our clients is not just about we do it for you. It's like we do it with you.
Sure.
With taking into account your specific risk return characteristics, obviously, but also, I mean, extra financial dimensions, if this is what you want.
Okay.
Which is quite new. I mean, to be able to do it.
Yeah. So let me ask, I mean, is there a key message or action item that you'd like to highlight for FPA members and the financial planning community?
Sure. When there's a will, there's a way. That's an important point, and that's a key point, because I mean, you're probably aware of the what we call the behavioral gap.
Yep.
You know, this behavioral tendency which we have to react to market whipsaws, and obviously to get in and get out of investment vehicle at the wrong time. And at the end of the day, I mean, investors, they can destroy up to 30 or even 40% of the performance of the investment vehicles they have selected just because of behavioral issues. And the reason why it's so important, I mean, to go beyond performance, is because when you are in the middle of the storm, you will not convince your client to stay invested because of performance. Because it won't be good at that point. So you better have something else. You better have the possibility to show them, not only to remember them the reason why in the first place they have to suffer the volatility of the market, but also, and above all, to show them that the portfolio is aligned with their core values. Because in the middle of nowhere, in the middle of the storm, you better have something greater than you that is guiding you. So that's I think, the main reason why, I mean, investors, they should think about more than performance. And very clearly, I mean, performance obviously is a very important dimension, but it's not the only one anymore. And very clearly, I was talking about Wealth 3.0. I think that Wealth 3.0 will be holistic, or it will not be, I guess.
Yeah. Well, Mathieu, with that, I want to thank you. First of all, thank you for contributing to the Journal of Financial Planning. Thank you for doing the research.
Thank you.
And thank you for being part of Behind the Research. We appreciate it.
My pleasure. Happy to talk to you.
Excellent. Thank you, Mathieu. And I just want to let all of you know that you can dig into this exciting new research in the May issue of the Journal of Financial Planning, which is now available to all FPA members. You can simply scan the QR code on the screen or visit fpajournal.org. So thank you for spending a few minutes with us, and we'll see you next time on Behind the Research.